So, congratulations, you finally made that business that you've dreamed of for years, or you started a side hustle. And you're growing, you're putting some marketing dollars towards it, you're going out there making sales, and your business is growing slowly but surely, which is how it should be. But after a while, the question comes into your mind: when is the best time for me to scale? Am I ready to expand? How do I know if that's possible? Well, this is where a lot of businesses unfortunately fail, meaning that they are growing, they have a lot of customers, they're selling a lot of their products, and they say, wow, it's a really good time to grow. It's a really good time to expand because I have a ton of these customers. I'm selling a lot of my products. I'm doing well, right? I was told that growth is everything, meaning growing in sales, growing in customer numbers, growing in my addressable market, growing market share is the only metric I need to use to expand. And you can see there's a lot of online content that is catered exclusively towards this because they're mostly marketing experts. They're folks who are very focused on sales and marketing, and they say, well, if you have sales and marketing down, that's the only metric you need to look at to grow. I do think sales and marketing is important. I think that when you start your business, there is a lot of momentum you need to build to grow your business. But when it comes to meaningful scaling and meaningful expansion, you have to look at other metrics. So today, in the series that I'm doing, we're going to answer that question for you. I'm going to teach you in this video series how to read financial statements, how to evaluate your business using those financial statements, and how can you use those to answer more fundamental questions that are: is my business doing well? Is my business ready to scale? Is my business ready to go? Remember, you're an executive, you're the president of your own company. You need these financial statements to understand when it's time to grow. And unfortunately, when it comes to financial analysis and making business decisions based on those, you're alone. You're on your own. You have to do it yourself. Obviously, you have financial analysts, or what I always recommend, having a CPA to help you understand your financial statements, prepare them for you. But usually CPAs are not really good when it comes to secondary, tertiary data, meaning they just give you financial statements and they give you pointers about where your company is. But it's also up to you to look at that, make an executive decision, and just go with it. In the last video, we discussed income statement, which outlined your revenues and expenses and gave you a net income. Today, we're going to discuss one of the most important financial statements, if not the most important, especially for your small business, and that is balance sheet, which outlines your assets and liabilities, and based on those tells you what is your equity, which is a great indicator for you to see if you're over leveraged or if you're ready to scale your business, and if you need to make fundamental adjustments to your business to make sure that your business is healthy and is not in danger of bankruptcy. Remember, 90% of the small businesses fail within the first 5 years. Obviously, some of them could be due to not having proof of concept, not having enough sales, not having enough clientele, not doing a robust enough marketing and sales, but a big chunk of them are due to financial mismanagement. What does that mean? Meaning many business owners start their expansion, start growing, start wanting to open a new location, start wanting to serve a new market, but they don't understand that they are either over leveraged, they don't have enough assets to help them sell, or that their business is not mature enough yet for that expansion. Well, balance sheet is a great way to indicate that and help you make the right decision for your business. So let's dive into it. So income statement is outlining the things that you own, your assets, or things that you owe, liabilities, and based on that gives you your equity. First up, things that you own. Hopefully you own a lot of it. Assets. We have current assets and we have fixed assets, or sometimes you hear long-term assets. Short-term assets are usually cash or cash equivalent, which means that assets that can be turned into cash within a year. These are some of the examples of it. Usually the cash in your bank account, accounts receivable, meaning that you earn that revenue, you accrued that revenue, but the customer is yet to pay you. That can be turned into cash relatively quickly. Or things like that: inventory, office supplies, general business supplies. These are more liquid assets that can be turned into cash fairly fast. So these are all your current assets. And then we have fixed assets, or we call it long-term assets. These are usually the assets that have a useful life of more than a year. They can be turned into cash fairly quickly. An example of that is PPE, personal protective equipment. No, I'm kidding. I mean property, plant, and equipment, which is the real estate that your business owns, the machinery and the equipment that you use to run your business. These are some of the examples of your fixed assets or long-term assets. These tend to be more of an operational asset, meaning these are things like your machinery, your grill, your fryer, things like that can help you run your business. There's actually a ratio for that we discussed before. We call that efficiency ratio, which is your total sales divided by your total assets. Tells you what's the utilization rate of your assets. Well, there is a new ratio that you can also use using your fixed assets only, meaning that since your current assets are mostly cash, accounts receivable, things that are not operational, you can actually divide your total sales by your total fixed assets and get a ratio, which we call that turnover ratio. I personally like efficiency ratio a little bit more because it puts all of your assets in play, because sometimes the cash in bank, sometimes your cash can be turned into fixed assets, and usually business owners don't know when they need to keep cash or convert that cash into machinery or equipment that can help them expand. We see oftentimes, based on my experience, that small business owners, especially when they're starting out, they get to be a little bit overzealous with saving cash and keeping cash in their bank accounts, and their sale is either plateauing or is lowering, or they want to grow and they don't know how to. So efficiency ratio is also a good ratio for you to say, wow, my efficiency ratio is low. I need to convert some of that cash to more operational asset so I can increase sales. Which turnover ratio doesn't do that. Turnover ratio just evaluates how efficient are your fixed assets as we see it now. But before we go into liabilities, there's another section of assets that I'm a big fan of. We call that intangible assets. If you watch my EBITDA video, we discussed intangible assets as well. So intangible assets are the assets that a business owns, but are types of assets that we can't really see or touch or feel them, but they are usually acquired by the business. For example, if your business name and logo has a trademark, that trademark is an intangible asset. If you have a very fire mixtape on SoundCloud and you copyrighted it, that copyright that you have on that mixtape is your intangible asset. Here are some of the examples of intangible assets. As you can see, that domain is very long, and you can add it into your balance sheet as your assets, because these are real assets. You can't just see them or feel them, but they exist. They give value to your business. It's added value to your operations. And add them all together, you have your total assets. It's a very important number, because even though that we teach you how to go out there and analyze each section of your assets, total assets are very important because that gives you an indication of how much you own. But the good stuff are ending. We have to go to liabilities. These are the things you owe. Again, liabilities are not always bad. A business needs liabilities to operate. You can't avoid that, whether it would be in different categories that we'll discuss down the line. It's not always a bad thing, but we'll discuss how to manage liabilities at the end of the video. Current liabilities, or things that you owe, are the liabilities that usually mature within a year or less. These are some of the examples of them. You can see things like accounts payable, meaning that your business has a supplier that brings you food and ingredients, and you have to pay it at the end of the month. So when you accrue that expense, you have to have a liability on your balance sheet as an accounts payable. Usually you have to pay that within a year or less, for things like interest payable, taxes payable, and so on. In this section, I'm going to bring up working capital ratio again. Working capital ratio is your current assets divided by your current liabilities and gives you a ratio. Ideally, you want that ratio to be 1 or more. If it's less than 1, that means that you don't have enough current assets to satisfy your current liabilities, meaning if you were to pay them all off today. So you want to make sure that you increase your cash position, increase your liquidity position, and that's where working capital loans come from. So you can take advantage of that to always increase your working capital ratio. And then we have our long-term liabilities. These are liabilities that are matured or amortized for more than a year. Long-term loans, real estate loans, things that you have to pay off for a long time. These are some of the examples of long-term loans. Obviously, there are more categories. Usually with liabilities, short-term and long-term liabilities can be similar in nature, but just because their amortization or maturity timeline is different, they usually get categorized in each different section. Meaning if you have a loan payable, but you're set to pay off that loan within 8 or 9 months, it usually gets put into the current liability section. But if you have a loan that is matured over 3 or 4 years, these are things like term loans, SBA loans that have a longer maturity date. You can put them into the long-term liability section. So you're gonna add all of your liabilities together and you get a number. So far you have your total assets, you have your total liabilities. So what you do is take your total assets minus total liabilities, and that'll get you to equity. We discussed equity a lot. So equity, whether in a public company is shareholder equity or in a private company is owner's equity or capital, tells you if you use all of your asset to pay off all your liabilities, how much money is left. Equity is something that you have to understand that is a function of your assets and liabilities. It's not a number that you get from anywhere else. This is something that took me a while when I was in accounting school to get to understand what really equity is. So if you want to make it simplified, equity is just a function of your total assets minus your total liabilities. And that shows you how much equity you have or how much equity you built in your business. But depending on how much equity do you have, there are components that you can add to it. For example, retained earning. That is how much of a net income from last year you retained minus the dividends you pay to the shareholders if you're a public company, and things like shareholder equity, or if you're a private business or you're a partnership, owner equity. Sometimes in different partnerships, there's a general partner and limited partner equity. So they will all be placed in the shareholder equity section. The amount of them depends on how much equity is left in your business. For a small business, equity is really depending on the industry you want to get in. For example, some industries that are very capital intensive and have a higher barrier to enter, for example, HVAC business, construction business, hospitality business, they need a lot of startup capital. So therefore, if you're using leverage, meaning you go to a bank and take an SBA loan, or you go and take a small business loan from a private lender, you have a ton of liability to start with and maybe not much of an asset. So your equity will be very low, maybe sometimes even negative. Or for example, if you're in fintech is big and it's very capital intensive, and that's why fintech and venture capital go together like peanut butter and jelly. Or industries like transportation, like these fancy little jet buses that go from New York to DC, and you have to buy all those buses. You have to make sure that you set everything up, you have enough drivers, you have enough infrastructure, you have the technology. They all cost money. So if you go and borrow a ton of money to acquire them, then you're under a ton of liability, meaning that most of your assets are being eaten up by the amount of liability you have. So you start up with a very low equity, but as you make sales and as you decrease your debt, as you increase your assets, hopefully using the sales and revenues that you have, you build up equity. Same thing with real estate. You might have a 85% or more loan to value ratio for your investment property, but if you do it right, you do the numbers right, as you are collecting rental income, you can pay off your mortgage and increase your equity slowly but surely. So when you want to start a business, it's really important for you to know if the industry that you're very interested in and if you want to start a business in, is it capital intensive? Because if it's capital intensive and you don't have a ton of cash or ton of capital to inject into that business, you have to use leverage, meaning borrowing some money to make some money later, but that comes at a cost, and that cost is lower equity. So that's it. Balance sheet, very simple, very easy. And one thing that you want to understand about balance sheet is that at any time during the year, you can pull up your balance sheet and read it, and that'll give you a really good view of where your business is. Something like an income statement is accumulative, meaning as days go by, as you increase your sales, as you increase your expenses, they get changed. So it's kind of hard to compare end of 2021 data with year to date for 2022. You have to do some projections, you have to do forecasting to see what will be my end of year for 2022 net income, and then you can do a one-to-one comparison. For balance sheet, that doesn't exist. You can compare end of year 2021 to year to date 2022 because they're not accumulated. Your asset and liability numbers are stabilized, and as time goes by, they change, as opposed to income statement where your revenue and expense levels accumulate on top of each other as time goes by. And last but not least, there are tons of metrics and measures and ratios that we can use to evaluate both income statement and balance sheet. I discussed it in the income statement video and this video as well. But if you want to know more about it, if you want to know more about some of these ratios that you might hear as well, but you might not understand it, comment below. Tell me what type of ratio you want to know about for your small business. I'll be more than happy to make a video. Before we go, as you know, this was supposed to be a real estate channel, just like any other real estate channel out there. I want to discuss about your real estate investment journey. If you're savvy enough to make the LLC and S Corp and go through all those corporate structures that we see on TikTok and so on, I bet you can be savvy enough to have a CPA or create a balance sheet that outline your assets and liabilities as well. It's a really good practice to know that. It's much simpler for real estate because you are monetizing a specific asset, and with that comes liabilities, which mostly is your mortgage. So it's much simpler. So take some time to study that, to read that, to understand where your equity is and have a timeline for your growth. For example, you can build up X amount of equity before you want to take out something like home equity line of credit or home equity loan to go out there and invest in another income producing property. But you can't do that if you just have a very low or no equity. You have to build up some equity, but it's up to you. You know your income and expenses, and you know how much of your liabilities, which is in this case mortgage, you're paying off to get to the equity level for you to go out there and use that as a collateral. Obviously, with this market, We saw prices go up a lot, so you might have been a little bit spoiled on equity, but market is slowing down. Market is becoming a more stabilized and normal market. Maybe those good times might be over. But take on a good practice of seeing, okay, where your equity realistically will be so you can have a successful investment. Thank you so much for watching. It's been a pleasure as always. If you like a deep dive or a video from other financial ratios, comment down below. I'll be more than happy to do one for you. Every like and subscription is a spear to the heart of these TikTok gurus. If you like to watch income statement and how we do the same analysis for income statement that help you understand it on a deeper level, watch this video. It's very good. We discussed how to improve your business, how to improve your sales, and how to have a really good healthy ratio. This video with other finance fundamentals videos is in a playlist. So if you like this video, if you think that it gives you some value, go watch those videos again. We discuss different ratios, equity, things like that on a deeper level. You can always listen to it in the background while you play Fortnite. But as always, thank you so much for watching. Love you all and keep learning. See you next time.